I think all credit to the government of India to think that, why should we export financial business outside and jobs outside?
Many people still come to use GIFT Nifty as the benchmark.
We put out our methodologies for public consultation. We interacted with a lot of multilateral institutions.
When you compare in the international market, these are the exemptions which are available under the tax treaties that India has signed with many countries.
How far have we come? How more do we need to go for? And we have Dipesh Shah, and who better than him, because he has been associated since 2008. So he has seen it rising, rather in a bud stage, and now flowering. So how far have we come? And do you think, when can you truly say that we have arrived?
Thank you. Thank you, Khushbu, for this, organizing this very important panel on the GIFT City. I'm sure the participants in this room probably are well aware of GIFT by now in terms of what is happening on ground there. And when we say that as it truly arrived, I think let's talk on some numbers as to where we stand so that we can appreciate what is happening in that financial center. I think first, as you said, that in compared to other financial centers, if we really look at London and US, obviously it's a 100-year story. You're talking of a financial center well established. And then you look at some of the other new financial centers, so for example, DIFSC in 2004, and then ADGM in 2015, and to some extent even Malaysia tried Labwan in 1989. So there has been the history of financial centers which has been moving, in terms of undertaking international financial services business. And most of them have been riding on India opportunity, because what I used to see was that, when we meet those financial centers representatives, they do a very special session in India to understand our problems. They go back, they correct their regulations to bring more India business into their financial centers. So I think for them, it was just to plug India issues and you have, large business to do. And I think all credit to the government of India to think that, why should we export financial business outside and jobs outside? Why can't we attempt GIFT? But for us, the GIFT is probably a center on the block. But as we have passed 5 years and there are some numbers, let me say that we have crossed now 1,000 registrations in the financial center itself. And this numbers has moved from 129 to 1,000. In just a matter of 3 to 4 years after the Financial Center Authority got established there. We have touched $100 billion of banking asset size now sitting in GIFT, which was probably zero, because most of our lending were all coming from outside India, and we were not lending from India dollars to Indian corporates and to outside. So we have $100 billion of banking asset size sitting now. I think you have Bala sitting here, and he just messaged me in the morning, $103 billion, highest monthly turnover on the stock exchange ever, which means that in even the monthly turnover on the stock exchange is across $100 billion now. And we are also talking of 35 business segments operating in GIFT now, which is not purely a traditional banking, insurance and capital market. We have moved much beyond that, and we have now alternate investment funds, you have finance companies operating there, you have fintech firms operating there, and even foreign universities operating there. So if you really compare this, and if we compare ourselves with maybe ADGM, because it was 2015, obviously when you start with comparables, and if you really see what is happening in ADGM as we speak, I think we already crossed the banking asset size. We already crossed the number of banks that we have versus what the ADGM today has. And probably we should now eyesight ourselves to DIFC as to how can, quickly we can make ourselves comparable to DIFC, and then probably slowly move towards what Singapore is doing in terms of the international financial services. So I would definitely answer positively that yes, GIFT has arrived. It is now in the interest of everyone to make it more rapid and more faster and make it more comparable to Singapore and other financial centers.
So definitely, we're talking about the milestone on the NSE today, and there's another milestone that it is achieving on the direct listing part. We obviously know that one company has already been there. How many more are we expecting? And as Sir said, obviously, there's been a lot of activity on the fund management side. It has doubled nearly in just last 1 year. So last 1 year has been a highly active stage for, at least on the fund management side. For you, how do you see how many more companies are we looking forward in the next half year or so? or even for the next fiscal? What is the outlook like for that?
Thanks, Khushbu. And I think Dipesh has set the right context. So I think NSE International Exchange, which is the only one subsidiary of NSE, is the leading market infrastructure institution within GIFT City. We actually have more than 99% plus market share in all the segments which we actually operate in. And typically, coming to derivatives, we are already proven to be very successful. In fact, for many in the audience, they may not know, the GIFT Nifty futures is something which people can wake up in the morning and watch where the Indian markets are. And even we trade almost 21.5 hours. So effectively, even for post-market events, and in the last 1 year, we had many of that, many people still come to use GIFT Nifty as the benchmark. And the beauty is that we are now almost trading on a daily basis, almost 2 to 2.5x of the total futures volume in India. Okay, so that is something which is very less known. This week, we also touched another milestone of almost $22 billion open interest. So open interest is the true liquidity measure as far as the risk management markets are concerned. And there again, our numbers are 4 to 5x of India's open interest on the Nifty. So this is just to get a benchmark. Obviously, over the last few years, we have enabled many Indian companies to raise debt capital. And debt capital has become a serious business. I think now more than cumulatively about $80 billion of medium-term notes programs have been established, and almost close to about $55 to $60 billion of bonds have been raised. And that numbers are going to grow fast because just last month, RBI also liberalized and allowed more companies from India to start tapping the external commercial borrowing framework, and that I think should definitely augur well for us. Now coming to your pertinent question on listings. This is something which has been there since day one. So there were two ways we could actually approach investments market in the GIFT City. One was, I was part of the core team way back in 1993 in NSE. And NSE was a new exchange with an 100-year-old institution. And what we did there was we quickly created something called a permitted to trade category. And we got the top stocks which are listed to actually be allowed for permitted to trade. So we had a similar proposal which we had given way back in 2019 to SEBI, because at the time SEBI was the regulator. IFSC got created in 2020. And we still are pursuing it. Basically, the idea was that there are many Indian companies which go to New York, NASDAQ, or to London, Luxembourg, and issue depository receipts. So one of the ideas was, can't we look at the top 250, 300 names where foreigners are investing, if we can get a depository receipt market going in the international side in GIFT City. That would have immediately created an investment ecosystem market, and a lot of people would have started using it as a thing. So today, we have all the Indian derivative products available with us, but we don't have the Indian equity products available with us. So what we are now looking at is actually creating fresh IPO issuances. I think after IFSC got created, the listing regulations were published. And I think last year they actually smoothened out the regulation. And now we are seeing one company called XCD, which is an Indian company, which has actually filed an IPO with us. It's a small one. It's about, they're going to raise about $15 million. But apart from that, we have also been doing roadshows since last 1 year in terms of how we can actually get many companies to come and do IPO. I can't give you specific names, but at least 3 or 4 companies, even companies from Silicon Valley, are in touch with us. They are actually looking at filing IPOs, and these are going to be significant one, because we are looking at the sweet spot where people can raise something between $50 to $200 million. Because in US markets, typically issues below $1 billion cannot go and get an IPO. Thirdly, we are also seeing new trends where many companies now are even approaching us for a direct listing, because they think that the corporate governance norms, the listing norms, the disclosure norms are all good, and they want to build a credible reputation. And at some stage, they will basically go and do a follow-on issuance where probably both resident Indians, non-resident Indians, as well as international players can come and co-invest in that.
Yeah, thank you for giving that detail on how many Silicon Valley companies are planning to come back to on our own international exchanges. There are a few pertinent questions here, but we'll take them after we have had a round of discussions, both on the expiry date that you have mentioned and on the participation from the different class of investors. I'll come back to Revti here. You are one of the participants here, which has a very different sort of business, and you are one of the two earliest companies or the credit rating agencies to set up in GIFT City? What brought you here? What opportunities do you see?
Okay, thank you so much for that question, Khushbu. Whenever a financial ecosystem has to develop, you definitely need firstly the regulator. Then you need exchanges, depositories, the issuers. You also need, trustees. You also need a rating agency because that's really completes the financial ecosystem, and that's where we kind of plug in. So we are very much a part of the buoyant financial ecosystem which is developing in GIFT. IFSC came out with a credit rating agency master circular in 2024, and we were the first to apply to get a license. And we have a regulator who is market friendly and looking at opportunities to create business in the market. And we immediately got our registration last year in July 2024, and we started operations in October 2024 by launching ratings on 39 countries. Now, the reason why you need a rating agency from a country like India is that, for very many years, we have seen only the US-based rating agencies dominating the world rating market. And when we got to study the methodologies that they are using for rating different countries, we found that there is so much value to be added to get the methodologies current. Because, if you look at the world GDP today, 45% is contributed by emerging economies. And when that's such a significant portion of the world GDP, then there is a very important reason why emerging market nuances should be inbuilt in global rating methodologies, which we thought was not happening. So that's the reason that we really started doing this exercise much before we applied, about last 2 to 3 years ago. We put out our methodologies for public consultation. We interacted with a lot of multilateral institutions to see how we can hone those criteria. And we are so proud to say that when we launched our business in October, we launched it with 39 country ratings. We rated India BBB+. And in the last 1 year, we have seen in 17 out of those 39 countries, the global rating agencies moving in the direction of our rating, which is a very significant validation of the work and the necessity for a rating agency per se.
Do you think you can outgrow your domestic counterpart of your own group firm?
The opportunity is huge, Khushbu. So here we are not looking at only just like NSE, IX, and IFSC is not looking at only attracting Indian companies to come and list on the exchanges. Similarly, we are not only looking at Indian companies to do the rating. So right now, we've done about $4 billion worth of issuances, which we have rated in that company. And we've done about 17 company ratings. These largely are Indian companies who have gone to the GIFT market to borrow or would go to the GIFT market to borrow. But as we speak, along with the other players in the ecosystem, we are also doing a significant amount of outreach to countries, firstly the neighboring countries in Asia, countries in Africa, where we are proposing a very credible alternative to a DIFC or a SGX. And SGX has, about 2.73 trillion worth of bonds listed. GIFT has what, 70 billion, $65 billion worth of bond listed. So you can see the size of the opportunity.
Well, all the best for that achievements, and we see how you grow the same trajectory and the momentum. I'll come to Tushar, and there's one perception, obviously, because the taxation regulations and the relaxations for the GIFT City had come very early, and we saw there's a perception that it's for tax saving. Do you believe in that perception for the HNIs or something? Or how do we break apart from that perception? Or how good is to stick by that perception?
So, as you know, that GIFT City got set up, and as Deepesh sir also rightly pointed out, it's basically that you saw a lot. India is an importer of capital, right? So there's a lot of capital which comes from offshore market, whether it's US, whether it is Europe, whether Asia. And we had to, the idea of GIFT City was effectively to onshore the offshore financial services, right? Because a lot of capital comes from third country and gets into these financial centers like, say, Singapore or Mauritius. Now, of course, it's no more, but Mauritius at that time was quite popular, right, from a jurisdiction perspective. And also Luxembourg Island. These are the jurisdictions, right, which are known for rendering financial services, whether it's about, say, funds investing into the country, or whether you're talking about banks lending into the Indian ecosystems, and many others, right? So idea was to create the financial center within India, right, and which is what the GIFT City is. And for any new financial service center, you have to create a pull factor, right? Because you can't expect a financial service center to be successful without there being a pull factor. But I don't think so. While there is a overarching 10-year tax holiday, which acts as a pull factor and is a tax incentive, but in general, I don't think so the government has gone crazy about how the tax incentives are given. Now, let me give you an example. While, say, look at a fund industry, right? So there is specific exemptions for public market funds, which are raising money from non-resident investing into the country, where other capital gain other than shares are exempt, or interest and dividends are taxed at 10%. Now, you might say that, okay, it's a tax incentive. But when you compare in the international market, these are the exemptions which are available under the tax treaties that India has signed with many countries. Like you look at India-Singapore treaty, or same as Mauritius treaty, or a Lux or Island treaty, it gives exemptions for capital gain other than shares. It gives lower withholding tax on interest and dividend. So if you don't give the similar treatment in IFSC, what is the reason for these funds to come and set up here? So it is not that it is all about taxes. It's more about creating ecosystem within the country, creating more jobs within GIFT City. And to give you an example on the fund, so what is selling from a fund perspective is that in treaty and all, you have a lot of uncertainties. You have what we call as general anti-avoidance rule, where the treaty entitlement good questions, there's substance requirements. So those issues go away because the GIFT structures give you significant certainty, and which is why we see almost 280 funds. 300 funds now, of course. He will have the latest number. I have the 2 months old number.
I'm just waiting for the September bulletin because every
Yeah,
time.
that's good.
So far
Even I
had
pulled it
reviewed-
from 277 as I saw in the last bulletin, but he says more than 300. So that's on the fund. But if you look at other regulations, like you look at GCC regulations, right? So we have Bank of America, which is the first, I think, the large GCC which is set up with 3,000 people. While they get the tax incentive, but the fact that it's created so much of employment within India, it has created ecosystem around employment where the government can benefit of. So it's not all about taxes. The tax benefits are more specific in terms of the areas in which there needs to be given. And that Indian government has used taxes as an incentive for a long time. Like if you want to set up a factory in Northeast, you get a tax incentive.
So is there a case to extend this 10-year period? Because many fund houses or any other entities say that still, if you are planning or if you are setting up somewhere outside their own jurisdiction, 10 years is still a short term.
I would tend to agree, and in fact, I'll tell you why. Because, okay, on the funds, I must say, the exemptions which are given on the fund is permanent. So it's not because when you set up a fund, you're dealing with third-party money, you have to give certainty, right? So those exemptions are permanent. So those are not subject to 10-year limit, but general exemption is. And of course, I think there is a case for extending that because people are looking at, because GIFT City, the professor is working in 2008 and he was in GIFT when we started working with it before IFSCA was set up to kind of see how the regulation can be framed and all. I think the time now is the time. Ball has started rolling, right? So now you will see, of course, the 10-year tax holiday applies from the time the entity sets up. So it's not from whatever, it's not like a certain date that from this date to this date. It's from the time you set up your business, you have 10 out of 15 years that you can choose. But still, I think giving us longer term certainty to businesses in terms of tax holiday would be important, and there is a case for extending that to whatever, at least 15, 20 years, at least that gives a long horizon to the businesses.
So we'll come back on the suggestions part, but one question for Dipesh. You are a unified regulator, but you are still dependent very much on the domestic regulators for many policy decisions, be it allowing FPOs, be it allowing brokers in GIFT IFSC, be it allowing the cross-border transactions on that basis, you are dependent on RBI, on family investment, the FIFs that was to be set up, also that you need certain permissions or consultations with the RBI, and for capital market you need for the SEBI. So how do you see your independence, or how do you see your policy making being impacted or by all these other dependencies on other regulators?
I think what you said is was partially true when the IFFC was not created, because that was the time when the domestic regulators were creating the carve-outs for the IFFC zone also. But post 2020, when the Parliament passed the IFFC Act and the IFFC authority has been now placed there, the powers of all these four regulators are with IPSCA for the regulation making. So let me clarify, for regulation making, there is no dependency on anyone. It is the IPSCA which creates the regulation, goes for public consultation, and the similar process what other regulators follow, we also follow. So there's no issue there. I think what you are trying to refer to is that an Indian entity wants to come into GIFT to operate. Obviously, if they are regulated by the domestic regulator, you need an NOC from the domestic regulator and then you can enter the zone. If a foreign company comes into GIFT, he directly takes the IPSCA license and gets operational. Like, for example, a bank which is not licensed in India but wants to come into GIFT. And now we have such cases like the Taiwanese bank which is not in India but they are setting up in GIFT. And so there's no dependency for those matters. But what you are probably trying to convey is that are our policies needs a dependency on the domestic. So for example, 100% NRI participation. Now, this is where you should give credit to the domestic regulators that they thought a carve out for GIFT. If you come from Singapore, you can't have a 100% NRI fund. You come to GIFT, you can have a 100% NRI fund. Now, this type of carve outs, which will give a preferential treatment to your own financial center, will probably help us to move fast, because you are competing with very established financial center outside. And for so many years, they have the credibility of tax, they have the credibility of regulations, everything. So if you give this type of preferential treatment to your own center, I think our speed of getting there will fasten.
So I'd like to add to this, what he's saying is that, even if you look at the credit rating regulations which IFSCA has come up with, they are not borrowed from the local domestic regulators, but they are actually aligned more with the international regulations for credit rating agencies. They align with the ISO code of conduct. So, there are certain products which are not allowed in the domestic market, like private credit ratings, which are allowed internationally and are allowed at GIFT. So some of these things which, in terms of regulations, I would second that they're not looking at the domestic regulator. They are actually looking at international regulators.
Just to add further, so I was on the asset management committee which recommended the regulation. And if you look at the alternative regulations in GIFT, which is applicable, is completely different. It regulates the fund manager and not the fund, while the domestic regulator regulates the fund and not the fund manager. And she rightly pointed out that the regulations are very forward-looking. The competition is not India. Competition is the international financial centers. The other thing and I think it's a misnomer to say that there is a dependency, because there is zero dependency. So as Dipesh sir pointed out, there is a foreign bank coming in or a foreign broker coming directly. They don't need to worry about it. They need to look at the IFSCA regulation, and they will give the license based on whether they meet the criteria or not. The dependency comes when you are dealing with India, which will come irrespective of which country you are set up, whether you set up in IFSC or you are set up in Singapore. If you are investing in India, in a capital market, you have to meet the FPI regulation. In fact, there are advantages of IFSC, as Dipesh sir pointed out, that you can have 100% NRI fund, which can't do in Singapore. You can do it in IFSCA, but that is related to FPI regulation. Or even if the Indian financial service player is going out, then of course you have to meet the regulations of the domestic market. The one other important you talk about FIF, right? Now, if you set up an outbound fund, and that is one of the big theme currently going on in IFSC right now. There are more than 20 outbound one. And there is LRS money. There is a broker which has got about 20 million LRS accounts already opened in GIFT in IFSC. There you can invest in a fund which is set up in IFSC up to 20% of net worth of any entity. which you can't do in Singapore. So there are actually advantages. There is no dependency.
So rightly pointed out, so because now the GIFT City is opening for retail mutual funds also, and we have seen certain entities setting up the retail category for mutual funds, and also on the FIF side, we still hope some more participation will obviously come. But aligning with the global part, I think one thing that NSE International Exchange has aligned is the zero-day expiry. But which is very different from how we approach the derivative segment in the domestic side. Any views on that? Because on the domestic side, it is seen as we are trying to limit the number of expiries. On the IFSC, as globally aligned, it is more of zero-day expiry, that every day you have an expiry.
So I think this buttresses exactly with the topic you discussed. So we are aligning all our regulations with the global jurisdictions. Zero-date options have been in existence over the last 10 years. And in fact, it is a pretty popular product in US. And in fact, many other jurisdictions have also started adopting it. I think GIFT IFSC also is one of the early adopters, let me put it that way. So I think the regulatory framework which IFSCA has adopted is forward-looking, progressive, and in tune with what is the global benchmarks. And that is the reason why it has been permitted. It's a very recent kind of a thing. Secondly, many people have concern because they think it again from India prism. So one is on derivatives, no resident Indians are allowed to participate. So this policy doesn't impact anybody in India or the India's regulatory stance as far as derivatives regulations are concerned. So we are primarily talking about dealing with international participants, dealing with non-residents, and also prop shops which are actually becoming offshore from India, which come into GIFT City. So these are the set of players who are going to look at it. And thirdly, when I started, I said the derivatives market is double the size in terms of the volume or 5x in terms of the open interest. This shows that derivatives are very popularly used by international players on any exposure in India. Sometimes they may not want to do an investment in India, but they can actually take a synthetic bet using derivatives, and that is the reason why the offshore markets have a very large derivatives presence. If you look at Singapore, for example, we keep on hearing that they're a financial center which has been established over 50 years now. Their derivatives market size is extremely large. Their cash market size is very small. Okay, so why I'm saying is that GIFT IFSC also will in some sense provide a large play for people to come and use synthetic products, and that is where it comes.
So one more, sorry, I'm cutting in. One more space where resident Indians are not allowed is direct listing, participating in the listed entities that will list on the international exchange. So do you think that will lead to any kind of liquidity concern, because it's a still growing market? People would trust more from a jurisdiction like India, where you are more well versed with. Like the investors would be well versed with or more confident on IFSC at this stage. Do you think that will concern the liquidity, or do we need any address on that?
So there are two things. India today has already become a very hot IPO market. So effectively now a lot of Indians are coming to the market and directly investing. Now this opportunity is now being slowly realized by international companies. If you look at in the last few years, all the big major companies of international companies which have come and started doing some work in India, they all started creating IPOs in India, and somewhere the Indian companies are much larger than the global parent. So this is exactly the trend which actually GIFT also wants to accentuate. So there are many foreign companies which may want to look at GIFT IFSC, where they can raise both money from Indian investors because their LRS is permitted, because Indians can invest in foreign companies using the LRS route. And the international pooling of capital can also happen, and it can happen in our own financial center. So that is eventually the big aspiration. Obviously, over the next 10, 15 years, as India becomes more affluent and we start rising towards becoming a middle income country, and that is what the Prime Minister's vision is of basically Viksit Bharat by 2047. I'm sure more and more capital will be provided by India for international opportunities. And that is the reason why I mentioned why Silicon Valley companies in AI and other fields are now looking at GIFT City as a place where they could list, because they think they can actually raise capital from Indian investors. That is definitely there. But from a segregation perspective, Indian companies which are coming to raise foreign capital in GIFT City, their Indian investors cannot invest. But foreign cap companies which are coming to GIFT City, they are open to foreign investors as well as Indian investors.
So Revati, coming to you now, we'll move forward to a little of what kind of challenges that you have seen in the last 1 year or over 1 year that you have been there, and any solutions that you think of for the same thing? And would you also want more competition for you to come to GIFT City now that you have been the pioneer there?
Okay, so very early days actually. So early days always will bring together with it a set of challenges, a set of teething troubles. It's more on visibility and outreach. So I think that's where most of our efforts and most of the work is. Firstly, visibility and outreach for GIFT as IFC as a center for people to look at and come. Secondly, Carriage Global as a global rating agency. To bring acceptability in the minds of investors, in the minds of lenders, so that they can rely on our ratings. Which is why I said, in the first year itself, we've got great success. In fact, we rated India BBB plus, and after that, there are 3 rating agencies who have upgraded India. So it's just a matter of 1 year that you have 3 rating agencies just following us, even for our home country. And with no home country bias, mind you, a lot of rating agencies do have home country bias. So we want to establish a very credible institution from out of India where, investors can place trust. And that is really the work and the challenge, both that we are right now addressing.
Thank you. So we are running a little short of time. We'll come back for some audience questions. You can think of your questions. But in a moment, we have one very pertinent question to both Mr. Tushar and Dipesh. Every year, we look forward to the union budget because every year there's a gift for the GIFT City. So what are your suggestions this time, or what are your hopes for both of you quickly on from the union budget for GIFT City?
I think gift are best enjoyed when they are surprised. So let's keep it surprise then.
I can at least ask industry's expectation. You as a regulator can't talk about it. I think couple of things, I think, which industry has represented for a long time to the government and to IFSCA, which are pending. I think one is, of course, the extension of tax holiday. I think there is a case for extension. The second important aspect is the whole outbound fund. So if you look at, there is a specific tax regime when it comes to inbound funds. So whether it is public market, it is private funds, there is a specific tax regime. You know exactly how you will get taxed. But when it comes to outbound fund, for private, there is not a problem because you will still get a pass-through, so you're fine. But when it comes to public market, which is where I think the main interest, if you look at the 20 odd funds which are set up in IFSC on outbound, are all, most of it are public funds. There's no specific tax regime. So it faces with the same issues that you have if you're aware about the whole category 3 issues in the domestic market. It faces the same issue. There's no clarity how the taxation works. And many of these structures are set up in form of a trust. So then you rely on a trust taxation regime which is set up while the Indian income tax, now of course we're changing it, but it's just a rewriting of the existing law. It's an act like the trust law was set up in 2064, meant for private trust, not meant for something like AIF ever, right? So we need that as one of the important aspects. Of course, I understand there could be concerns around the fact that there's an outbound flow of capital, but this can happen in any other country. So same principle that why would you allow other financial center to develop those products which are available to resident? And as people now, there's a lot of liquidity, right, with the educated Indians, and people want to look at diversification, which is why you saw one of the broker who has set up a global access has now 20 million LRS accounts in a very short period of time. So this is an example where people are looking at these products, and so that's one important ask, that have a specific tax regime for outbound fund. The second ask is a safe harbor regime. So there is a concept of safe harbor under the domestic. There is Income Tax Act Section 9A, which is already there, which basically says that if you are offshore fund, and if your fund manager is based in India, then it raises several tax issues. So the safe harbor basically gives a kind of a safe harbor to the fund, saying even if you have a fund manager sitting here and managing offshore funds, will not raise a tax issue for the fund. Will treat the fund as non-resident. It can be entitled to treaty, which is wherever it is set up. So in GIFT, there has been a lot of ask because there are many global fund managers they want the India team, because India is like a, you know, you would have heard all about the GCC growth and all that, right? And there's a lot of outsourcing opportunity, and it's more of a KPO opportunity in fund management space. So we have brilliance of mind in fund management, and there are global fund managers who want to kind of ask their domestic fund managers to manage offshore funds which are not investing in India, even investing in globe. So it's nothing to do with the India investment. They're saying, okay, they will may manage a public market fund which is investing in Japan and other countries, right? So that we should permit in gifts particularly. So that's a second big ask.
Yeah. You want to ask?
So Kushbu, just one last thing which I wanted to mention because I missed it out. So recently, NSE International Exchange has set up a wholly owned subsidiary called the NSE International Exchange Global Access. So this is a very new initiative. This again was enabled by IFSC recently, wherein they introduced a new license called the Global Access Provider. So this is a very safe, regulated manner under IFSC's regulatory framework, where Indians, resident Indians, can now start safely investing in international markets. And clearly, like what Indian exchanges, I think 15 years back, when SEBI actually allowed exchanges to become a platform to actually pool mutual fund investment money. Similarly, we are now creating something similar for outbound investment. And I think this should start going live probably next year, early January. And I think that will be a good opportunity, especially for investors who are looking to diversify their holdings